Snam S.N.A.M., traded as SNRY on the OTC market or SRG on the Borsa Italiana, BIT, represents a compelling investment in essential European energy infrastructure. The company's business model is fundamentally defensive, characterized by highly predictable, regulated cash flows, insulated from volume risk. As Europe pivots toward greater energy independence and decarbonization, Snam has solidified its role as an indispensable Southern European energy bridge and an accelerating multi-molecule operator. 1.1. Investment conclusion and key drivers. The current institutional assessment places Snam with a hold recommendation, exhibiting a strong positive outlook bias that points toward a buy opportunity upon clear execution milestones. While the valuation is attractive relative to peers, short-term upside remains capped by technical overbought signals, high, though manageable, leverage, and uncertainty surrounding future WACC resets post-2025. Snam is best viewed as a regulated income growth vehicle rather than a growth momentum stock. The investment thesis is underpinned by four critical drivers: regulatory resilience and favorable offsets. Despite a challenging interest rate environment leading to a reduction in the allowed weighted average cost of capital, WACC, Snam's operational and financial performance has been robust. The company reported a strong increase in adjusted net profit of 10.0% through the first 9 months of 2025. This resilience is directly attributable to effective regulatory agreements, notably the application of the Italian IPCA, Harmonized Index of Consumer Prices, for the revaluation of the regulated asset base, and the benefits derived from the new ROS mechanism, which collectively offset WACC pressure. Centrality to energy security. Snam's infrastructure is vital for European energy policy, especially concerning diversification away from traditional pipeline sources. The company manages 1/6 of the entire European Union's gas storage capacity, 3, and has rapidly deployed new liquefied natural gas (LNG) regasification capacity, including FSRUs in Piombino and Ravenna. This infrastructure solidifies Italy's position as a critical southern gateway, reinforcing Snam's political and strategic importance. Strategic pivot validation and capex deployment. The comprehensive $12.4 billion strategic plan for 2025-2029 validates Snam's transition to a multi-molecule operator, integrating green gases like hydrogen and biomethane. A significant de-risking event occurred when the flagship South H2 corridor, an expansive hydrogen pipeline project, was granted Project of Common Interest status by the European Commission, securing political momentum and paving the way for regulated returns on future assets. Attractive and secure dividend. Snam's dividend policy is highly transparent and aggressive for a utility. The company confirms a minimum annual growth rate of 4% through the 2025-2029 plan period, supported by a carefully managed maximum payout ratio of 80%. This high-visibility income profile makes Snam a core holding for income-focused portfolios. 1.2. Financial and operational highlights. 9M 2025 snapshot. Snam has consistently delivered high single-digit growth in its key financial metrics. The company upgraded its full-year 2025 guidance following the results of the first 9 months of the year. For the first 9 months of 2025, total revenues reached $2,846 million, marking a 7.4% increase compared to the first 9 months of 2024. This growth was primarily fueled by increased regulated revenues generated by the gas infrastructure business. Adjusted EBITDA rose by 6.6% to $2,227 million, a result supported substantially by the aforementioned regulatory revenue increases and ongoing cost efficiency measures. Adjusted net profit demonstrated exceptional growth of 10.0%, reaching €1,096 million. This strong performance reflects not only EBITDA expansion, but also enhanced contributions from both domestic and foreign associated companies. The positive operational trajectory is formalized in the strategic plan, which projects a 4.5% adjusted net income compound annual growth rate (CAGR) for the 2026-2029 period, providing the financial foundation for the guaranteed dividend growth commitment. I. Company profile and core regulated business model. Snam S.p.A. is one of the world's leading integrated energy operators and a fundamental cornerstone of Italy's and, increasingly, Europe's energy system. With over 80 years of experience in infrastructure management and construction, Snam guarantees supply security while actively promoting the transition to green gases. 2.1. Snam's systemic positioning in the European energy market. Snam's operations span the integrated midstream energy value chain, including transportation, storage, regasification, and the supply of natural gas, servicing local distribution networks, industrial users, and thermoelectric plants. Critical infrastructure dominance. Snam commands significant market share across key regulated segments. Natural gas transportation. Snam is the leading operator in Europe, managing a vast pipeline network exceeding 40,000 kilometers both within Italy and across its international footprint. This network connects Italy to key European markets and southern supply routes, extending the company's presence to countries including Austria, France, Greece, Tunisia, Egypt, the UAE, and the UK. Storage capacity. The company is strategically crucial in gas storage, holding approximately 1/6 of the European Union's entire gas storage capacity. This capacity is essential for balancing seasonal demand and securing geopolitical supply stability. As of September 2025, Italy's storage level was reported at 92%, notably higher than the approximately 82% average across the EU, underscoring Snam's operational focus. Regasification capabilities. Snam ranks as the third largest European player in regasification, managing or co-managing an estimated annual capacity of 28 billion cubic meters (BCM). This capacity is managed via one onshore terminal in Panigaglia, La Spezia, which was Italy's first LNG facility built in 1971, and two critical floating storage and regasification units located in Piombino and Ravenna. Geopolitical mandate and operational agility. Snam's current operational phase is highly leveraged to the geopolitical necessity of diversifying European energy sources, particularly reducing reliance on Russian pipeline gas. The rapid deployment and operational commencement of the Ravenna FSRU in May 2025 serve as a critical demonstration of Snam's operational effectiveness and ability to deliver strategic infrastructure under tight political timelines. This agility in execution proves the company's reliability in a high-stakes environment, strengthening its governmental and European mandate for future mission-critical transition projects, such as those related to hydrogen. By September 2025, Snam had facilitated the docking of 165 LNG tankers in Italy, accounting for over 30% of total gas volumes, with approximately 50% originating from the USA. 2.2. The regulatory anchor, the stability of regulated revenue. Following the ownership unbundling from Eni and subsequently from Italgas, Snam operates under an ownership unbundling regime, ensuring independent infrastructure management. This structural separation ensures that Snam's capital allocation is exclusively focused on infrastructure stability and long-term regulated returns, removing potential competition or conflict of interest with major upstream companies. This purity of focus significantly enhances the defensive quality of Snam's investment profile. Snam's core business segments, transport, storage, and regasification, are governed by the Italian regulatory framework established by ARA, Autorità di Regolazione per Energia, Reti e Ambiente. This framework is highly protective, crucially providing a zero-volume risk model. This structure means Snam's regulated revenue is determined by the value of its recognized invested capital, the regulated asset base, or RAB, and an allowed return calculated via the WACC methodology, rather than being subject to market fluctuations in utilization rates. 3. Regulatory framework and return analysis, ARA. The relationship between Snam and ARA defines the financial predictability of the company. ARA's key functions involve defining the criteria for tariffs, allowed revenues, and setting quality standards for infrastructure access. 13. 3.1. The allowed return mechanics and WACC trends. The foundation of Snam's predictable earnings stream is the allowed return on the RAB, identified by the real pre-tax WACC, which is calculated using the Capital Asset Pricing Model (CAP) methodology. 14. In the short term, Snam has faced predictable pressure on its allowed returns. The real pre-tax WACC saw a decrease from 6.7% in 2024 to 6.2% in 2025. 14. This reduction in the allowed rate of return represented a measurable financial headwind estimated to have reduced regulated revenues by €50 million in the first half of 2025. This sensitivity to regulatory resets remains a perpetual risk for regulated utilities, particularly in volatile economic environments. 3.2. RAB growth and favorable regulatory offsets. Crucially, the inherent stability of the Italian regulatory regime has demonstrated a systemic commitment to ensuring the regulated business remains viable, even when market conditions necessitate a WACC reduction. ARA has successfully implemented several compensatory mechanisms that have fully cushioned the negative impact of the WACC reduction, allowing Snam to post significant net income growth. These compensatory regulatory tailwinds include IPCA index adoption. Starting with 2025 revenues, ARA mandated the adoption of the Italian IPCA for revaluing the invested capital, RAB, for regulatory purposes. This shift in the index used for calculating capital inflation recognition directly boosted the size of the RAB base, generating a revenue increase estimated at €67 million in the first half of 2025. Investment plan rollout and RAB accretion. The execution of the active investment plan directly translates into RAB growth. The capital deployment added a further €73 million to revenues in H1 2025. Total investments in the first quarter of 2025 amounted to €361 million. ROS regulation benefits. The application of the new regulation by Objectives of Expenditure and Service (ROS), particularly for transportation activities since 2024, has been beneficial. This mechanism allows for better remuneration of work in progress, often referred to as fast, slow money mechanisms, and shortens the depreciation time lag. This adjustment is fundamental as it reduces the financial risk associated with the regulatory time delay between incurring large capital expenditures and subsequently recognizing that investment in the RAB base, thereby improving cash flow quality. The strong 10.0% adjusted net profit growth achieved in 9M 2025 is fundamentally the outcome of this effective regulatory cushioning. The financial results confirm that the strategic growth of the regulated capital base, coupled with the favorable IPCA revaluation index, is the principal driver of the company's earnings trajectory. This structural reliance on RAB expansion, fueled by the multi-billion euro capex plan, confirms Snam as a predictable, asset growth-driven utility stock. The projected 4.5% adjusted net income CAGR for the 2026-2029 period is therefore driven not by volatile market opportunities or margin expansion, but purely by consistent RAB expansion and regulatory recognition. IV. Strategic growth and energy transition execution. Snam's long-term value creation is anchored by its ambitious shift toward becoming a multi-molecule operator, leveraging its dominant position in gas infrastructure to facilitate the energy transition. 4.1. The 2025-2029 Strategic Plan, Fueling Future RAB. The strategic roadmap outlines a robust $12.4 billion investment plan for the 2025-2029 period. This massive capital expenditure program is allocated across two main priorities. 1. Enhancing midstream gas infrastructure to ensure competitive and secure energy supply, and 2. Accelerating the development of energy transition businesses to drive decarbonization. The plan is deeply integrated with stringent environmental targets. Snam is committed to achieving net zero across all emissions, scopes 1, 2, and 3 by 2050. The company has already reduced its direct greenhouse gas emissions by 28% compared to 2022 and aims for a 40% reduction by 2030. Furthermore, the company maintains a high level of compliance with sustainable investing standards, with 35% of its capex aligned with the EU taxonomy and 57% aligned with the Sustainable Development Goals. Hydrogen and the multi-molecule platform. Snam is actively pursuing the transformation of its network into a multi-molecule platform, increasingly capable of transporting green gases. Hydrogen is identified as a critical molecule for decarbonizing hard-to-abate sectors and heavy transport, offering cost-effective transportation and reliable long-term storage. Snam's hydrogen strategy involves significant investment in integrating the molecule into the Italian supply chain. This includes the replacement of approximately 850 kilometers of existing pipelines with hydrogen-ready standards, proactively future-proofing core assets. Strategic initiatives such as the High Accelerator Program support innovative startups in the hydrogen sector, while projects like Idrogemo focus on renewable hydrogen development to contribute to regional carbon neutrality targets. 4.3. Deep Dive, the South H2 Corridor and European integration. The South H2 Corridor is Snam's most significant long-term strategic hydrogen project, demonstrating the company's critical role in continental energy policy. The project, promoted by Snam in collaboration with TSOs TAG, GCA, and Bayernets, entails the construction of 3,300 kilometers of new and adapted hydrogen pipelines. This infrastructure is designed to connect hydrogen production centers in North Africa, where renewable potential is high, to Italy, Austria, and eventually to major demand centers in Germany. Snam is responsible for developing the Italian backbone of this corridor. The project's strategic importance was confirmed in April 2024 when the European Commission designated the South H2 Corridor as a Project of Common Interest, PCI. This designation is vital as it reflects strong political support from the core governments involved, Italy, Austria, and Germany. 16. And unlocks potential European funding. Snam has already signed for 24 million euros in CEF co-financing for H2 projects. By converting what would otherwise be speculative long-term capex into infrastructure backed by significant political and financial endorsements, the PCI status materially reduces the execution and financing risk. Furthermore, the EU gas package provisions suggest that a new regulated framework for hydrogen infrastructure will likely emerge, mirroring the predictable zero-volume risk returns currently enjoyed by gas infrastructure. 13. This successful de-risking of future revenue streams is a crucial indicator of Snam's long-term value proposition. 4.4. Biomethane, CCS, and infrastructure upgrades. Beyond hydrogen, Snam is achieving tangible progress in other transition areas. Biomethane. Snam has 72 megawatts of biomethane capacity either in operation, authorized, or under construction, demonstrating effective implementation of diversified green gas sources. Carbon capture and storage, CCS. The company is advancing the critical Ravenna CCS project. Key governmental approvals have been secured, including a ministerial decree on technical standards for CO2 transport network design, construction, and operation, and the company has applied for Connecting Europe facility grants. Gas infrastructure upgrades. The core gas infrastructure is also seeing accelerated development. Phase 1 of the Adriatic Line, a key transport project, is 43% completed. Additionally, 857 construction sites were active as of September 2025, representing a 19% increase compared to the previous year, highlighting the intensity of the CapEx rollout. V. Financial performance and capital structure analysis. Snam's financial health is defined by its ability to generate predictable returns from its regulated base while successfully funding an unprecedented capital expenditure cycle necessary for the energy transition. 5.1. Recent financial performance and growth outlook.
The reported financial results confirm a trajectory of consistent, predictable growth, largely driven by the regulatory mechanisms discussed earlier. The strong first quarter of 2025 saw total revenues of €970, plus 8.3%, and adjusted net profit of €406 million, plus 21.2%. 15. The full-year 2025 guidance was upgraded based on the robust 9-month performance. Looking ahead, the 2025-2029 strategic plan projects adjusted EBITDA growth. A compound annual growth rate (CAGR) of 5% is expected, leading to group EBITDA of approximately €3.51 billion by 2029. This growth is primarily fueled by RAB accretion, cost efficiency, and initial contributions from the CCS network. Adjusted net income growth. A 4.5% CAGR is projected for adjusted net income, upgraded from 4% in the previous plan, primarily fueled by growing returns on the expanding RAB. 10. 5.2. Debt and liquidity management. Funding the substantial €12.4 billion capex plan necessitates significant debt utilization. Snam's leverage levels reflect this aggressive investment cycle. Net financial debt has climbed rapidly, moving from €11,923 million in 2022 to €15,270 million in 2023 and reaching €16,238 million by year-end 2024. 17. This upward trend continued into the first quarter of 2025, reaching $16,798 million. 15. The corresponding leverage ratio, net financial debt/adjusted EBITDA, peaked at 5.1x in 2023 before moderating slightly to 4.7x in 2024, benefiting from strong EBITDA growth. 17. This debt level is considered high but acceptable for a capital-intensive regulated utility that benefits from highly stable and visible cash flows. The significant jump in debt between 2022 and Q1 2025 suggests that Snam is front-loading its capex, particularly for mission-critical assets like the FSRUs. This aggressive pace generates short-term leverage risk, but the risk is deemed tolerable provided that the accelerated investment translates rapidly into RAB recognition and regulated revenue streams, ensuring the projected 4.5% net income growth target is met. Snam successfully manages this leverage by utilizing sustainable financing instruments, with approximately 86% of its funding derived from sustainable sources. 5. This strategy provides access to competitive capital and reinforces institutional support. The company maintains a solid investment-grade credit rating of Baa2 with a stable outlook from Moody's, as recently reaffirmed and revised in April 2025. 18. However, Snam's rating remains intrinsically linked to the Italian sovereign rating due to its systemic role and regulatory dependency, exposing it to external, unhedgeable systemic risk. V. Valuation and shareholder returns. Snam is generally perceived by analysts as defensively valued, offering a substantial dividend yield backed by robust financial commitments, yet the market consensus reflects caution regarding short-term capital appreciation. 6.1. Dividend policy and attractive income profile. Snam's dividend commitment is one of its most attractive investment features for income seekers. The company prioritizes attractive and sustainable remuneration. 11. The 2025-2029 strategic plan confirms a guaranteed minimum annual dividend growth of 4%. 10. This growth is explicitly managed within prudent limits, with a maximum payout ratio capped at 80% throughout the plan period. 10. The reported payout ratio in 2024 stood at 74.88%. 19. The projected 4.5% net income CAGR through 2029 provides a sufficient buffer to comfortably fund the 4% annual dividend increase, reinforcing the safety and predictability of the income stream. 6.2. Relative valuation benchmarking. Snam appears modestly undervalued when assessed against key European peers and broader industry averages, reflecting a misalignment between its high-visibility regulated growth profile and its current market multiple.
Price to earnings. SNAM's P/E ratio ranges between 13.4x and 13.64x 20. This is substantially below the average P/E ratio of its peers, 19.9x, and also slightly below the global gas utilities industry average, 14.1x, 21. Enterprise value to EV/EBITDA. Snam's latest 12 months LTM EV/EBITDA multiple is 11.2x. This is lower than its own 5-year average of 11.5x, suggesting that the stock may be trading at a discount compared to its own historical valuation range, pointing to potential multiple expansion. The prevailing valuation discount, despite confirmed 4.5% net income growth and a guaranteed 4% dividend growth, is likely influenced by lingering market concerns over the temporary pressure from WACC reduction and the elevated leverage required to execute the capital plan. If Snam successfully executes the initial stages of its energy transition capex, thereby proving the stability and regulatory acceptance of future returns, the current valuation gap suggests a significant re-rating towards a peer average P/E, potentially 16x to 18x, would be justified. 6.3. Analyst consensus and price targets. Analyst sentiment is cautious but stable. Based on insights from 18 analysts, the consensus rating for Snam is neutral, comprising 8 buy, 7 hold, and 3 sell recommendations. The median 12-month price target is €5.4, based on the SRG MIL listing, with a high estimate of €6.4 and a low of €4.4. Relative to a recent trading price of €5.55, the median target suggests marginal downside potential of minus 2.63%. This neutral consensus is consistent with current technical indicators, which show a high relative strength index RSI of 76, suggesting the stock is currently overbought and likely due for a technical correction, advising against aggressive accumulation following recent price highs. 7. Risk assessment and sensitivity analysis. While Snam benefits from a regulated monopoly structure, its investment profile is subject to regulatory, execution, geopolitical, and financial risks inherent in large-scale infrastructure development. 7.1. Regulatory and policy risks. The primary structural risk is the future determination of the WACC by ARERA. While the 2025 WACC reduction was effectively offset by favorable RAB adjustments, IPCA and ROS, future WACC resets, post-2025, remain sensitive to global interest rate movements and ARERA's assessment of systemic risk. A sustained global increase in risk-free rates without full regulatory recognition of inflation or risk premiums could place renewed pressure on returns. Furthermore, while the Italian framework is protective, the final details regarding the remuneration and risk profile for hydrogen and CCS investments, hydrogen RAB, WACC, are still progressing, introducing uncertainty for a significant portion of the planned $12.4 billion capex. 7.2. Execution and project development risks. The sheer scale of the 2025-2029 capex plan introduces substantial execution risk. Completing large, technically complex, multi-jurisdictional projects, such as the 3,300 km South H2 Corridor, 7, requires seamless coordination and adherence to aggressive timelines. Delays in construction can lead to cost overruns, push back the regulatory recognition of the asset in the RAB, and prolong the period during which the company services debt without generating corresponding regulated returns. For the medium term, 2025 to 2029, success hinges primarily on the timely and cost-effective execution of these transition projects. 7.3. Geopolitical and energy security risks. Snam's critical role in European energy security exposes it to macro geopolitical volatility. While the pivot to LNG and North African pipelines enhances energy security, instability in transit countries or major disruptions to global shipping routes, e.g. the Suez situation affecting LNG flows, 16, could impact operational continuity, even if revenues are guaranteed by regulation.
Security of supply remains contingent on maintaining stable relations with key suppliers, particularly those in North Africa. 7.4. Financial risks. The elevated net financial debt/adjusted EBITDA ratio, 4.7x in 2024-17, means Snam is susceptible to interest rate fluctuations. Although 86% of its funding is secured through sustainable finance, 5, which may benefit from favorable terms, higher borrowing costs resulting from future debt refinancing or the floating component of existing debt will inevitably pressure financial margins. Finally, the tight correlation between Snam's investment-grade rating, BA2, and the sovereign rating of the Italian Republic means that a deterioration in Italy's credit profile could trigger a review or downgrade for Snam, regardless of the company's strong operational performance. 18. Conclusions. Snam S.p.A. offers investors a unique blend of core regulated utility stability and high-conviction exposure to the energy transition mandated by the European Union. The company has demonstrated superior financial performance in 2025, largely due to a regulatory framework that effectively balances WACC pressure with strategic RAB growth through the adoption of the IPCA index and new ROS mechanisms. The core of Snam's value proposition is its predictable income stream, backed by the guaranteed 4% annual dividend growth through 2029, a commitment supported by the projected 4.5% adjusted net income CAGR. The valuation currently presents a compelling case for long-term accumulation, as the company trades at a notable discount PE 13.4x relative to its peers, average PE 19.9x. This gap suggests that if Snam successfully delivers its front-loaded $12.4 billion capex plan, especially securing the foundational regulated returns for the South H2 corridor, a significant re-rating is highly probable. Actionable strategy. Prospective investors should initiate a position during any near-term pullbacks resulting from the current overbought technical status or minor market volatility. Snam is a critical component for income-focused portfolios seeking regulatory defense and mandated exposure to the multi-decade European energy transition. The successful attainment of milestones related to the Adriatic Line completion, CCS project advancements, and the progression of the South H2 corridor's regulatory framework should be monitored as key triggers.